Well, good morning and welcome to the Reserve Bank. With me, I've got Grant Spencer, who's the Deputy Governor and the Head of Financial Stability. New Zealand's financial system is resilient and continues to function effectively, but risks to the financial stability outlook have increased in the past 6 months. Although New Zealand's economic growth remains solid, the outlook for the global economy has deteriorated. Despite highly accommodative monetary policies and low oil prices, growth is slowing in a number of trading partner economies. Dairy prices remain low, with global dairy supply continuing to increase. Many farmers now face a third season of negative cash flow, with heavy demand for working capital. Imbalances in the housing market are increasing, with house price inflation lifting again in Auckland after cooling late last year and early this year. House prices have also begun increasing strongly in a number of regions across New Zealand, although house prices outside Auckland are generally much lower relative to incomes. The bank remains concerned that a sharp slowdown could challenge financial stability given the large exposure of the banking system to the Auckland housing market. Further efforts to reduce the imbalance between housing demand and supply in Auckland remain essential. This includes measures such as decreasing impediments to densification and greenfield development, and increasing infrastructure and other constraints to increased housing supply.
In the banking system, capital and liquidity buffers are strong and profitability is high. However, the system does face challenges. Internationally, credit spreads have widened, placing upward pressure on the cost of funds for New Zealand banks. The level of problem loans in the dairy sector is projected to increase significantly over the coming year, although we do expect that losses on dairy loans will be absorbed mainly through reduced bank earnings. On housing lending, while the impact of the LVR restrictions on house price inflation has been transitory, the restrictions have substantially reduced the proportion of risky mortgages on bank balance sheets. This is providing an ongoing improvement to financial system resilience. The bank is closely monitoring housing market developments to assess whether further financial policy measures will be appropriate. Finally, the Reserve Bank continues to make progress on key regulatory initiatives. Consultation papers on proposed changes to the outsourcing policy for banks and on changes to bank disclosure requirements will soon be released, and a consultation paper has recently been released on crisis management for financial market infrastructures. Thanks.
Well, happy to take questions.
Has the likelihood of the bank introducing new or further LVRs on the housing market, in particular in Auckland, increased?
I think it's fair to say that we're becoming increasingly concerned about the Auckland housing market, that house price inflation looks as if it's accelerated in February and March. We hope to see the RINES data this afternoon. And investor activity is driving a lot of that market. I mean, if you look at the transactions in Auckland, say over the last 3 months, 42% of those transactions are driven by investors. For the rest of New Zealand, it's around 40% of transactions driven by investors. We've seen the LVRs really being quite successful in changing the riskiness in a structural sense of bank portfolios. I mean, if you go back to 2013, for example, the proportion of the loan book that was at LVRs greater than 80%. At that point, it was about 21% of the loan book was highly leveraged. At the moment, with the LVR policy, that's down to 13%. So will we look at further macroprudential? Yes, we are. We need to do more analysis. We need to have discussions with the finance minister, but I think it's fair to say that we're seriously looking at macroprudential.
Does that include loan-to-income ratios?
Well, you know, there's several things in the toolkit, I suppose, in terms of macroprudential policy, one of which is debt-to-income ratios. We've been collecting data now for quite some time of debt-to-income ratios for borrowers. We've been collecting that data off the larger banks. I think it's likely we'll start collecting that data off the smaller banks as well. But it's something that we would look at. It's been successful in other countries, particularly the UK has recently adopted debt-to-income ratios. But let me see if Grant wanted to add.
Well, we currently have 4 tools in the toolbox in the sense of being listed in the MOU with the Minister around macroprudential policy. But as Graham says, we've been looking at the debt-to-income issue, and we feel that's definitely a sort of a relevant area. Certainly it's an instrument that's been used in other countries. And so, but if we were going to move in that direction, we would need to bring it into the MOU and discuss it, obviously, with the Minister. So it's not quite at the same state of readiness, you might say, as the other instruments that we have listed in the MOU.
Just finally, so what is the message to New Zealanders here, and in particular those who are perhaps engaging in property investment, that if the Auckland market continues at the rate you've seen in the last month or so, you will introduce new measures?
No, I wouldn't exactly use those words. I mean, what I would say is we're concerned about the rate of house price inflation in Auckland. If you look at house price to income ratios, that ratio in Auckland is now over 9. Prior to the GFC, it was around 6.5. If you look at the rest of the country, the average is about, I think, 5.3. So in other words, Auckland is 70% higher in terms of that ratio than the rest of the country. So that's a concern. We know that Auckland is now one of the most expensive cities in the world in terms of that ratio. We know that investors are a big part of driving the market there. They account, as I say, for about 42% of the transactions. But it's not just Auckland. I mean, we're seeing house price pressures building up elsewhere in the country. I mean, if you look at Hamilton and Tauranga, then house price inflation is moving somewhere around 18 to 25%, depending on how you measure it. So it's not just an Auckland issue. So it does pose a financial stability risk, and that's why we're essentially looking at whether there's scope for further macroprudential policy.
Have you got any views on the British proposal to increase LVRs for investor housing, and is that an approach that would be attractive to you?
Let me see if Grant or any other colleagues.
I'm not familiar with that proposal that you're talking about. Is anyone here? Chris?
So basically this is a proposal around the interest service coverage ratio of investors in the UK. So it's similar to sort of a DTI type policy. And so I think there's been some coverage around sort of converting that into an LVR equivalent. So it's not actually an LVR policy per se.
It gives a sense if you've got 4 tools in the toolbox, one of which isn't loan to income ratios, are you indicating in your comments today that those four are less preferred than that.
Well, the four tools are the LVR restrictions, which obviously we've used on 2 occasions now. There's basically capital requirements and capital overlays, including the counter-cyclical capital buffer that's proposed by Basel. And the other one is the core funding ratio, which is a liquidity-based tool. But I think it's fair to say that the 2 main things that we've been that are sort of on the radar are instruments or measures around LVR restrictions and variations on that, and measures around debt to income, which we feel is an issue.
So if that requires both an MOU change and discussions with the Minister of Finance, is that timetabled? Can you give a sense of how that might play out in the next few weeks or months?
We can't really. There's no schedule or timetable. It's an ongoing assessment. We've been collecting data on this. Since mid last year or so. Yep. And so part of it is trying to improve that understanding of how these ratios are tracking, because we've only been capturing the data for less than a year.
The potential for more macro-prudential measures, is this something that you think would be focused on Auckland, or is it something that might need to be spread out beyond Auckland?
It could, I would say, it could be Auckland, or it could be nationwide. Our preference is to be simple and broad-based in our approach, rather than targeted approaches, which always get more complex. But certainly the situation we were facing last year was very much focused on Auckland and Auckland investors. I'd say since then, as Graham's just described, it has broadened considerably.
You mentioned in the Financial Stability Report that interest-only lending had increased, particularly for rental property investors. Some people have suggested you might look at restricting or banning interest-only lending. What's your view on interest-only lending?
We don't really think that's a very fruitful avenue to pursue. It's a complex issue, and there's no sort of simple solution in terms of trying to restrict interest only. That's our view.
Are you risking being a bit late in reacting by not introducing further macroprudential tools at this point? Is there any kind of virtue in waiting?
Well, there's always challenges in timing with any policy response. I mean, the challenge that we've got is, given what's happening globally with monetary policy, it's not feasible to increase interest rates in the foreseeable future. So we have credit growth that's growing at around 8 to 9%. And so macroprudential policy can play a role in trying to reduce the demand for credit. But look, this housing issue is a lot more than just simply macroprudential policy. On the demand side, you've got strong migration, one of the largest migration surges in the last 100 years that the country is experiencing. You've got low interest rates, which are a product of international interest rates plus policy settings here. And on the supply side, and that's really the heart of the issue, is trying to get a supply side response greater than what we've been able to achieve to date. And that's tied up with a whole lot of issues that are regulatory in nature, that link to planning processes, that link to the availability of land in terms of development potential. That's linked to the productivity of the building sector. It's linked in Auckland to issues of densification and unitary plan. So that's where a lot of the solution lies. It's trying to generate a greater supply-side response. It's not simply this can be fixed with macro-prudential policy. These imbalances are significant.
A couple of quick questions. Is there any indication you can give us on timing around these measures? Are we looking at a sort of a 6-month time horizon for when they might be implemented or announced? And secondly, when you introduced them a couple of years ago, you said they'd be temporary, and here we are talking about additional measures. Are we now stuck with these things forever, or do you still see them as a temporary measure?
On the timing, nothing specific. I mean, we're still doing the analysis. We're still will need further consultation inside the Reserve Bank and with the government. Are the measures permanent? We've never thought of them as permanent. We did reduce the LVR restrictions outside Auckland, and that was partly an indication that we wanted to be flexible in our approach. And, you know, if you had a market which was in much greater balance, then you wouldn't need macro-prudential policy.
I think, you know, in terms of this temporary thing, I mean, the housing cycles and the asset cycles are very long cycles. So while we're saying they're temporary, you know, there may be quite long phase between the on and off.
I don't think anyone would disagree with you that supply side is the biggest issue in the housing market, but none of those things you talked about in answering my previous question are going to happen in a hurry, are they?
Well, some of that's up to the Auckland Council in terms of the response from the advisory group that I think reports in July, and the council was indicated. I think from memory, I could be wrong, but I thought it was about 19 August that they're due to make decisions on the unitary plan. So that strikes me as important. The government has a budget that's due to be delivered. I don't know what's in the budget on housing, but certainly it's a priority for the government. So there's lots of things that can take place on the supply side, particularly around infrastructure, particularly around the release of land and the use of government land, for example. And also around the productivity in the building sector and the Auckland Council's decisions around planning and consenting.
In the comment, there was discussion that there was a lot of property investors might move to more buy and hold strategies going forward. What evidence do you have that about the size of the amount of property investors who are, you know, speculating in the Auckland market?
I mean, my colleagues can correct me. As I say, if you look at in recent months, investors account for 42% of the transactions and 40% outside of Auckland. Those transactions are driven by investors. If you look at the breakdown of investors, what seems to be a significant component are investors with essentially one, 2 or 3 houses in their portfolio. Sure, you see large investors there as well, in terms of that may have 10 or a dozen or more houses in their portfolio. But small investors are a big driver in the market once in terms of the data that we've seen.
I just wonder if you could explain, Grant, just a little bit about how debt-to-income ratios would work. Are they a blanket rule, or is it a speed limit type thing where a certain amount can be over a threshold? Could you just explain a bit?
Well, some other countries have used guidelines for banks as opposed to hard and fast rules. I mean, so that's a possibility. APRA's had this approach, and I think Bank of England as well. If it's a restriction, it could be something involving a speed limit. It could be differentiated between investors and owner-occupiers. I'm not saying it would. I'm just saying the range of possible options for designing an instrument around debt to income, where the basic aim would be to reduce the extent of high debt to income lending.
I guess just the question is because you talk about 42% of the activity being investors. A debt to income ratio might, for example, create some political roadblocks because it might take on first home buyers or cut them out of the market.
Well, that's right. So that's the sort of thing you need to think about. But I would say that, and there's a chart in the publication that shows debt to income for investors versus owner-occupiers, and it's considerably higher for investors, or should I say there's a higher proportion of investor lending which is at high debt to income levels. So I would say that if there was a policy that restricted the amount of high debt to income lending, it would probably impact investors more than first home buyers.
Governor, you mentioned the August 16 vote by the Auckland Council on the unitary plan. If the council were to vote against the plan, or it didn't include enough housing supply in the plan, how might that affect how the Reserve Bank thinks about its macro-prudential plans?
Well, I think we'll certainly be interested to see what decisions the Auckland Council takes. I mean, there are issues very much for the Council and for Auckland citizens, and I'm sure the government will have a keen interest in what decisions are taken. But I wouldn't draw a direct correlation between whatever that decision is, as complex as they may be, and macro-prudential policy.
And just looking at the issue of demand side, do you think the government needs to do more to reduce some of the demand side pressures on the housing market, particularly around tax?
I mean, they're always complex issues. I mean, for example, we've seen the government move in terms of the Bright Line test and the 2-year rule. And you certainly see countries overseas with capital gains taxes that do have house price inflation and supply-demand imbalances. So there's no easy solution there. And it looks to me as if in respect of capital gains tax that in essence, based on the views of the main political parties, that New Zealanders don't want capital gains taxes. But, there are potentially issues about, to take for example, investors, about interest deductibility or offsetting losses, to what extent they can be offset against other income. There are those sorts of issues, but that's very much up to the government and the Treasury. And, as I say, things such as capital gains taxes don't necessarily solve problems.
Just one more from me on a different issue. Open bank resolution and the attitude of New Zealand savers to whether their deposits are guaranteed. An FMA survey last year said that most New Zealanders thought there was some sort of guarantee on their term deposits in banks. Do you think the Reserve Bank and or the banking industry have a responsibility to inform depositors that there is no government guarantee and that you have the open bank resolution scheme?
I think we've been very clear in articles that we've written and comments that we've made that deposits aren't guaranteed. That there's credit risk with every investment decision that households and professional investors take.
But other government policies are communicated more directly and widely with advertising campaigns and that sort of thing. Do you think there's a need for the Reserve Bank and the industry or the government to correct what is obviously a wrong impression that savers have, according to this FMA survey, which said more than half still thought there was a guarantee?
Well, I think if people are confused about that, then there should be clarity, and I think the bank has tried to be clear about that.
It's something that you can help to communicate.
Just on the demand side of things, perhaps not so much around capital gains in the Bright Line test, but is there any case for the government looking at the tax incentives for property investing and whether the playing field is still skewed in any way towards investors looking at property over other assets?
These are always tricky issues, as we know. Tax policy gets very, very tricky in terms of incidents and transfers and deadweight losses and all of that. But if you look at the tax system, and I think this would be true of any political party who was in office, are there issues that create incentives or distortions for particular types of investment? And you then would want to look at issues about to what extent interest, for example, might be deductible, to what extent losses generated on a particular area of investment might be able to be offset against other income. There are those issues that I think are open for any party who's in power.
Governor, just on a different topic, can you tell us why MediaWorks have been excluded from press conferences, why they weren't excluded when you announced the outcome of the investigation into the leak, and whether you believe that journalists have previously been disclosing OCR decisions prior to the embargo being lifted?
Look, I will ask Mike to make some comments, but let me be clear. We've tried to be very clear in terms of the communications that we've made to date. We've also had several meetings with groups of journalists. Where we are at this point is we want to satisfy ourselves that if we continue with lockups, that we can be very confident about the technology risks that we would be taking. If you look overseas, we're not aware of any central bank that has lockups with analysts. We're aware of 3 central banks that have lockups with the media. And in each of those cases, the Federal Reserve, the Bank of England, and the Central Bank of Chile, the banks have complete control over the technology environment, particularly in respect of Wi-Fi signals and the like. So we're commissioning some work, getting outside consultants to come and advise us on our ability and what the cost would be for us to be able to be confident that we can control the technology risks that we would face. We can't continue lockups on the basis of trust. The fact is that if you look at turnover in the New Zealand currency, then based on the last BIS figures, which are a couple of years old now, the New Zealand dollar was the 9th most traded currency in the world. The turnover was $105 billion a day, Most of that takes place in US dollars, US dollar New Zealand currency pair. Most of it takes place offshore. But the magnitude of that trading is enormous. I mean, it's equivalent to something like 60 to 70% of the country's GDP by way of comparison. So that's where we are. We're commissioning consultants to come in and advise us on the technology risks, and hopefully we'll be able to be assured that we can cover those risks and that it's affordable to do so. But Mike, did you want to add anything?
Yeah, just to those other two questions, Hamish. This is the first press conference since we stopped media lockup, so this is the first opportunity that we saw to announce that MediaWorks is excluded. There was no press conference, for instance, or lockup, for instance, with the OCR. There was no press conference with that. So this is the first opportunity that we've used to do that. And whether we believe leaks occurred before or not, we have no evidence that happened, but equally we didn't ask for that. What was of interest to us was that evidence appeared of one leak, and we have followed up on that, and we've taken action as a result of that. And as Graham just mentioned, we are looking at a range of options that have been put to us as to whether lockups can securely occur or not. So that's where that lies at the moment.
Just a point of clarification on the debt to income multiple possibility. It sounds like you still have to negotiate it to be into the toolbox with the minister and then do the analysis. It sounds like it's a lower likelihood than changes in LVR, and if it was a likelihood, is it something that would take months, next year?
Well, I think Graham answered that question where we don't have a timetable on this. We can't talk about what the timing might be. But obviously, in the case of those instruments, yeah, there would be a process to go through.
Does that mean that LVRs are more likely than debt to income multiples?
I wouldn't say that, no.
Well, thanks very much indeed.